Ladies and gentlemen, good day and welcome to the JINDAL Stainless Limited earnings conference call. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note this conference is being recorded. I now hand the conference over to Mr. Anup Pujari of CDR India. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us on JINDAL Stainless Limited's Q2 and H1 FY21 earnings conference call. We have with us Mr. Abhyuday Jindal, Managing Director of the company, Mr. Anurag Mantri, Chief Financial Officer, and Mr. Gautam Chakrabarty, Head Investor Relations of the company. We will begin the call with brief opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation that was shared with you earlier. Now, I would like to invite Mr. Abhyuday Jindal to make his opening remarks.
Thank you. Good afternoon, everyone. On behalf of the management team of JINDAL Stainless Limited, I welcome you all to this forum. I trust that you and your families are safe and maintaining all precautions against the spread of COVID-19. I would like to first share the key highlights of the period, following which Anurag will take you through the operational and financial highlights of the quarter and half year ended on 30th September 2020. As the country moved into the unlocking phase, we started witnessing a notable improvement in the overall demand across various sectors. A better than expected rebound in business sentiment, coupled with JSL's agile response in manufacturing and supply chain adjustments, led to improved financial and operational performance in Q2. The domestic consumption of stainless steel made a gradual recovery through the second quarter and has reached pre-COVID levels now, in major sectors like auto, decorative pipe and tubes, and railway as well. Within auto, we witnessed remarkable recovery in two-wheelers and passenger vehicles. On the back of festive season demand in hollowware and consumer-facing segments also picked up. Our capability to innovate and expand product portfolio to mirror the market trends in a short span of time has enabled us to stay ahead of the industry growth in these unprecedented times. And as we speak today, our plant is running at near full capacity. Moving on to our market initiatives, buoyant by the exceptional response received in the pipe and tube segment, we launched the second phase of the co-branding initiative as JINDAL Saathi 2.0 during this quarter. This will cover even larger geography and remote markets. We are confident that this initiative will further help us to limit the counterfeit market, expand our presence in the current 7,000 crore pipe and tube market. It will counter forgery and bring genuine stainless steel products to our customers. On the industry front, to address the issue of subsidized imports, as per the recommendation of DGTR, the Ministry of Finance, Government of India, has imposed provisional CVD on Indonesian imports for 4 months. While this is likely to provide interim relief to the domestic stainless steel producers, the industry is hopeful that the government will continue to tackle such issues in future by having long-term solutions in place. To conclude, overall the sector fundamentals are strong and the domestic demand continues to grow at a steady pace. As the recent macroeconomic parameters are pointing towards a broad-based recovery in Indian economy, and with the onset of festive seasons, we look forward to continuing witnessing this positive demand. Before I close, I would like to share that the board has also approved constituting a committee to explore and evaluate various options of consolidating of the stainless steel business of JSL and JSHL and or other group entities by the way of a scheme of arrangement or otherwise. The ultimate goal is to realize greater synergies and with an objective of maximizing value for all our stakeholders. With this, now I would like to hand over to Anurag, who will take us through the operational and financial highlights of the quarter and year ended on 30th September 2020. Thank you.
Thank you, Abhyuday. Good afternoon and warm welcome to everyone joining us on the call today. I will briefly take you through the company's operating and financial performance for the quarter and half year ended 30th September 2020. As Abhyuday mentioned, earlier than expected bounce back in sales led to the net revenue from operation for the quarter at 3,156 crore. Following a sharp demand recovery on Q-on-Q basis, sales volume stood at 2,30,350 metric tons, almost touching the pre-COVID levels. The improved operational performance of Q2 FY21 was supported by high demand from two-wheelers, decorative pipes and tubes, and railway segment. Demand in consumer-facing segment also picked up in Q2 FY21 on back of the festive season stocking. EBITDA for the quarter registered 11% increase on year-on-year basis at rupees 352 crore. Streamlining production, inventory and supply chain management according to emerging customer needs largely assisted the company to post strong operational performance in Q2 FY21. The finance cost for the quarter stood at rupees 124 crore, registering a year-on-year decline of 11%. Coupled with a strong operational performance, this enabled company to register a substantial 88% year-on-year increase in the PAT performance. Let me now briefly take you through our financial performance on a half-yearly basis. The sales volume of H1 FY21 stood at 3,19,164 metric tons, backed by strong recovery in Q2 FY21. Our EBITDA in H1 FY21 stood at rupees 430 crore. Despite COVID-led business challenges, the EBITDA per ton in H1 FY21 stood at 13,469, within the range that we have been guiding so far. With consistent focus on deleveraging, the finance cost for the same period registered a 10% decline year-on-year basis. Profit after tax for the period stood at rupees 11 crore. JSL's relentless focus on strengthening its balance sheet has enabled us to garner a rating upgrade from CARE Rating and reaffirm Fitch India research rating and research, and during the first half of the fiscal despite COVID. As on September 30, 2020, our net debt stood at 3,215 crore, which is lower by 1,477 crore over the last 2.5 years. Going ahead, the company apprises to consistently undertake sustainable efforts to further improve its balance sheet and overall financial position. In conclusion, I would like to say that successful CDR exit and consistent improvement in financial ratio, your company is now very much focused on confident on delivering the consistent performance going forward and create value for all its stakeholders. This brings me to end of the address. I would now expect moderator to open the line for Q&A session.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone now. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1. We have a first question from the line of Amit Dixit from Edelweiss. Please go ahead.
Yeah, hi. Congratulations for a good set of numbers and thanks for the opportunity. I have 3 questions, if I may. The first one relates to your EBITDA per ton performance, which is higher than what we had guided in last quarter. So do you see this 15,000 plus EBITDA per ton as a one-off thing, or is it going to sustain going forward? That is the first question.
Okay.
Yeah. You want to answer, Amit, all the questions first, or you want us to answer one by one? We can answer one by one.
Yeah, sure. That is fine.
Yeah. Okay. So EBITDA per ton, as if you see on a H1 basis, we are still we have been guiding you consistently of the range of 12,500 to 14,500. The 1 quarter year's performance should not be taken into this. So overall market is looking positive. But we are very confident, even despite all the challenges, any challenges come, we will be delivering what our guidance is, 12,500 to 14,500, even if the second wave of COVID or anything comes up. So overall, we are very confident of delivering on a full year basis, 12,500 to 14,500 per ton.
Wonderful. That helps. The second question is with respect to debt reduction. So while it is praiseworthy that we have seen debt reducing progressively quarter after quarter, but is there an ultimate debt or some kind of leverage ratio that we are targeting before we focus on other avenues of capital allocation, such as capacity expansion or giving money back to shareholders or any of these sort of things?
See, our focus, Amit, is closely monitoring the leverage ratio, which is primarily the debt equity and debt EBITDA. Debt equity is now well within our control. I think we have a good headroom from debt equity perspective. But debt EBITDA, because there was a variation, Q1 EBITDA was very down, and therefore there were certain tailwinds on that EBITDA side. But now market looking positive, I think. But we would like to keep a very close watch on our debt EBITDA, so that our debt servicing never becomes a problem for as we have experienced in the past. So with this, now we overall look in a comfortable position, I would say, barring some of the debt EBITDA, which is primarily because of the lower Q1 performance.
No, is there a specific number that you're targeting with respect to net debt to EBITDA, such as 2.5 times or something like that? I mean,
typically 2.25 is the number which comfortably lender expects.
Okay, fair enough. The third question is it possible to provide some more contours around the options of reorganization or consolidation? I mean, particularly the timelines that you're looking at, or whether it would involve all the four entities, Jindal Coke, Universal Rolling Mill and Hisar, or I mean, is it possible to provide some more color on this, and particularly the timelines?
Okay. See, the board, as you were saying, board has now authorized the committee to look at all the best of all the possible options, and largely idea is to, as we mentioned, is to consolidate the stainless steel business of the group. Now that's the main theme. I think overall this committee will look at the best perspective from the interest of lenders as well as the shareholder, which include the minority shareholder. Considering all this, we expect the committee to come out with go for the board recommendation shortly before the end of this financial year. In next 2 to 3 months, I think committee will finalize the scheme, and then we will share it with you once it's approved by our board. But largely to answer, I think there are two main entities in the group, Ratan Jindal Group, which is the JSL and JSHL. As we have mentioned also, that idea is to consolidate the stainless steel business. Now, in what form and scheme of arrangement, that is still work in progress and is being worked out.
Okay. Wonderful. Thank you and all the best.
Thank you.
Thank you.
Thank you. Anyone who wishes to ask a question may press star and 1 on your touchtone phone now. We have next question from the line of Vishal Chandak from Emkay Global Financial Services. Please go ahead.
Yeah, thank you very much for the opportunity, and once again congratulations on a very good set of numbers, sir.
Thank you.
The EBITDA percent especially was way beyond what we expected. Coming to your guidance that you just mentioned, that you still would like to maintain the full year guidance for 12,500 to 14,000 rupees. Given the fact that we have already done 12,800 rupees for the first half, do you think it is we would be touching more on the higher side? Because if we look at the lower side, then year onwards from second half, are we saying that the performance would be slightly muted, or we should build in a robust performance from an
I think looking at the way the country has picked up and the demand is there from the auto sector and hollowware and other consumer driven products, we feel it should be towards the higher side. So more towards 13.5 to 14.5%, that should be on the higher side.
Great. That really helps. Second, so my question was with respect to overall debt that you are comfortable. You mentioned that 2.25x is what the lenders would be comfortable, but would you be looking at leveraging up to, let's say, 2,000 crores, 2,500 crores? Do you have any particular number in mind before you start looking at the capex for the next phase of growth for JSL?
See, I think let me answer from the debt perspective, and then I will ask Abhyuday to just enter that what kind of capex opportunities we have in Odisha. So just to from lend, I think overall debt perspective, as I mentioned, debt equity we have really brought under control. I think that looks good. EBITDA and debt service coverage ratio is also a function of the current year EBITDA and profitability. So that sometime because Q1 was actually a challenging quarter, but this time we want to go in a fashion that even if some challenges come for say 1 or 2 quarters, I think we are not at a stress. So that's why we want to really careful. I mean, this looking at now, there looks the opportunity at least, and we can always do a smaller part of the capex going forward in next maybe next financial year. I think maybe Abhyuday you would like to mention that.
Yeah, basically we have a huge operating leverage in Odisha, and right now is the time because we are almost nearing our 100% capacity. We also internally are looking at exactly like you're asking the same question, that when should we plan our capex, when should we be coming up with these new, so we can do it in a modular way. That is what we've decided because of the operating leverage, because when we were constructing the factory 10 years, 12 years back, the way it was made was that for the second phase of expansion with modular projects, either adding one AOD or one mill or one rolling mill, we can increase the capacity to 20 to 30% easily. So that is the plan. We don't want to take on further debt right now. We want to further consolidate, and our capex we are going to go in a modular way. So looking at the current demand and what capacity or what equipment we will need to add, that is what internally the work is going on.
Great. So, if I may, squeeze in a couple of more questions over here with respect to your capex only. As you previously mentioned that the option that we are currently looking at is, merging or maybe looking at reorganization of both the stainless steel businesses. But given the fact that we have, additional rolling capacity, and if we merge the rolling mill as well, so wouldn't that be a little quicker in enabling us to, harness more benefits from the expansion? Rather than setting up a new HSM altogether, that would again be a 2-year-long gestation period.
See, Vishal, rolling mill HSM is actually in a other entity, and there's no, because that we have a good arrangement on the arm's length basis, which is very well accepted by, has been done as part of the lenders and all this in a fair practices. That will continue for a long term. So we don't have to, even if we don't merge JUSL, we don't have to add that, because that will continue with that same arrangement in the JUSL, what the other associate company is.
Sure, sir. So, with respect to the ICD which JSHL has given to JSL, if you may kindly help us understand what is the net outstanding balance and how would you want to treat this in a scheme of arrangement with JSHL?
See, to answer the second question first, outstanding ICD is currently at around 900 crore is the principal outstanding. Now, how will it be treated? I think just wait for, as we said, I think we will come out with the final scheme of arrangement with that. But obviously at group level, obviously if these two companies get merged, obviously the net debt will be reduced to that extent because it's a group company debt 900 crore.
I completely agree, sir, that the 900 crore gets knocked off because of the group consolidation. But when let's say hypothetically, if you are looking at some kind of a swap ratio or a swap arrangement at a fair value, so one was how much is the interest on the cash flow? I think that would also be outstanding. So what would be that number, and would JSL be giving an equivalent value over there, or we should just treat it as, how do we look at that number? That's what I was trying to look at.
I think, see, Vishal, I think for as I said, that will be a detailing of the scheme of arrangement. I think we'll have to wait for that because we are, for the swap ratio, there are multiple methods and we will be, because depending on we have two listed entities, it will be a very fair way we'll have to come out with based on the precedences and without any of the ambiguity. I think those, so let's wait for that. I think we are working with our advisors on that basis to come out with a very fair way, which is obviously in the best interest of all the stakeholders.
Sure, sir. Thank you so much.
Thank you. We have next question from the line of Nishit Shah from Equitas Investments. Please go ahead.
Hello. Good afternoon, sir. Congratulations on a good set of numbers. I wanted to know what are the imports that are there currently? Like, say, in the month of October, what kind of imports did we see?
So, imports have little bit picked up, I would say, from still our FTA countries. From Korea and Japan is where the imports have picked up a little bit. And China is still sending material, even though there is duty and there is dumping. But China is still sending material, and it has picked up from the other FTA countries, which is basically Korea and Japan.
Could we get the volume number?
Volume, I think it is not out as of now. The official numbers for October are not out, but we can get back to you.
Okay. The next question I had was, how do we see raw material costs trending in the next half of the year, in H2?
Again, for nickel, it is very, very difficult to predict what is going to be. But the way all commodities are looking, we also expect our commodity prices to be on the higher side, above 15,000 levels for nickel. And I think there's going to be strong performance on commodity side. Anurag, any?
Yeah, I think, overall, right now, all the metal indices and underlying commodities are looking on a upper side. Having said that, I think the good thing, as we have shared with you earlier, we have really done our very agile supply chain. So in terms of we closely monitor our underlying raw material exposure to reduce the inventory variations at any of the performance on a regular basis. So that has really helped us, and that will be our endeavor to continue monitoring the underlying commodity performance in our overall WIP and raw material and finished goods inventory.
Right, but don't we benefit because we are making stainless steel out of the scrap route?
No, it's all governed by market prices. So, I mean, not really that way.
See, just to add...
Eventually, the scrap prices also, when the underlying commodity moves, depending on the quality of the scrap, there could be a time lag, but eventually that also moves.
Okay. And can we have the industry-wise numbers? I mean, you mentioned that we're seeing strong demand from auto, pipes, railways. So sales numbers industry-wise, like how much percentage of our sales went to the railways division and autos division?
So railway was a little bit down actually because the 3 coach factories have cut their production. Auto picked up. Auto in percentage, maybe Anurag you can calculate, but auto, let's say we used to do an average of 8,000 tons, 7 to 8,000 tons. Now it has picked up to 12 to 13,000. So almost a jump of 30-35%. And our hollowware segment also picked up by the same percentage, I would say. We were doing an average of 10 to 11,000. That has gone to 14 to 15,000 also now. Railway has dipped, I would say, by about 10 to 15% actually.
Okay. So when do we expect the final CVD to come?
I think they take a time period of 4 months, so we're expecting around Q4. I will say Q4. It's tough to say, I mean, how government will behave, but I would say Q4 is the time.
Okay. My next question is regarding the defense space. So I understand JSL is approved for supplying stainless steel to the defense sector, right?
Yes. Special steel. It's not, I won't call it stainless steel per se. It's more special steel. Yeah.
Special steel. So in case the merger goes through, the approvals would still stand, right?
Correct. Absolutely.
Okay. And what is the kind of cash outflow we expect on interest cost for the remaining half of the year? Is it going to be at the same level?
More or less, it's going to be same level. Reason being is that now volumes will pick it up. So in same way, like term loan will remain. Obviously, there would be some slight dip further in that. But overall, since the working capital volume will be increasing, because as we picked up volume, will require more working capital inventories and all this thing in Q4 probably. So I think we should say almost the same level we should close the year.
All right. Thank you.
Thank you.
Thank you. We have next question from the line of Sunil Jain from Nirmal Bang. Please go ahead.
Yeah. Good afternoon, sir, and congratulations for good number. Sir, my question relates to... Hello?
Yeah, please.
Yeah, my question relates to since post CVD implementation, are we seeing any change in the prices of stainless steel adjusted to raw material? Hello?
So I won't say there will be too much of a direct linkage, but because of the sentiment, there has been a upward trajectory because of that, but we can't relate it directly to CVD.
Mainly because of the demand outlook.
Correct. There are 4-5 other factors. CVD definitely does support it and helps it, but it's not the only factor.
Yeah, and can you give some outlook on the graphite price, how direction to that?
Yeah, so graphite electrode prices have been, more or less stable at this similar level, around the Q1 level, 275 to 78 rupees per kg. And the domestic prices are likely to remain within that range only.
Okay. And with this merger and all, we will be, as you said, cited that the company merged. So, to be specific minority shareholder, we can take commitment that minority shareholder will be fully taken care of.
Yeah, that goes without saying. I think maybe.
Oh, that is definite. I would also like to give my sort of assurance. Yes, thank you. My assurance that is a big concern for us. We know as a company, as an organization, last 10 years, we have not done anything, but this is some time that if the performance remains strong in Q3, Q4 as well, then, a lot of plans are there actually. Let me not say right now, but there are a lot of plans that we not preempt, but we will be taking care. I would like to give that assurance.
Yeah. Thank you very much for this kind word, and all the best for the future.
Thank you.
Thank you.
Thank you. We have next question from the line of Navneet Bhaiya, an investor. Please go ahead.
Hi, sirs. Congratulations for a wonderful performance, not just over the last quarter, but over the last 2-3 years. It's quite remarkable how you've turned around this company. My question is, I think Anurag had recently come in an interview, guiding on the second half, the EBITDA as well as the volume. So, since you're operating at full capacity, does that mean you're doing at about 90,000 tons per month right now? Or is it lower, as in does 1.1 million translate to available 1.1 million capacity, or is it a little lower?
See, what I said is that because Q1 volumes were very low, it's less than almost, so I think if we consider that the year still, despite the low Q1, we expect not more than 10% down as compared to the previous year. We cannot obviously achieve the previous year volume in this year, because even if we run at 100% capacity currently, obviously because of the quarter one impact, it will always be on a 4-quarter basis. There would be some impact, but impact will not be like one quarter is 25%. So we are saying I think we will recover large part of it, but still there would be a 10% reduction from the previous year volume side. On profitability side, I think we are seeing a strong demand and all this thing. I think overall we should be able to done better in our profitability side, because all the measures which we have taken internally as well as support by the external demand.
Okay, perfect. My second question is, with respect to your debt parameters, you would probably reach, your desired numbers in 3 or 4 quarters, at the max 2.25 debt to EBITDA. So on the capex, that you were alluding to earlier, how long does it take? I remember Anurag had once mentioned that you can raise your capacity from 1.1 to 1.8 with a 500 crore capex in Odisha. So 2 questions related to that. How long will, this program take if you were to go ahead with it? And second, do you see the Indian market absorbing, the incremental 0.7 million ton if you were to go ahead of supply coming in? As in, is the demand growing at the same pace?
Okay, I'll take this question. So, to set up and to expand by another 0.8, yes, it would cost us only around 500-600, but because these are major equipments, big equipments coming from Europe and all these, USA, so it ends up taking about 18 to 24 months. That is the time for installation and commissioning. And by that time, we definitely see the market also increasing. Stainless steel market actually is growing at 10 to 12% per annum. It is the fastest growing metal. So, all segments, railways, auto, consumer-driven products, hollowware, they are all growing. ABC sector is a very big one. Infrastructure, stainless steel and infrastructure is growing tremendously. There are projects we are doing, FOB, stainless steel bridges are coming up. At least 4 or 5 will come up next year itself. So in terms of demand, it is absolutely very strong, which is why other countries, other companies are also looking at India as a big market. So the demand will definitely support the expansion.
Okay, understand.
Navneet, just one to add on this, just to clarify on one part. This 5 to 700 we are saying about the melting, and if we have to double the cold roll, there would be a requirement of another 5 to 700, just to give you that perspective, depending on, but as Abhyuday mentioned, we can always go in a modular way. That's an option with us. Because we don't have to now do all the capex together, but just to give you that to double each capacity, it will be that sort of block, 5 to 700 crore.
Okay, I understand. So a decision on this respect could be expected from the management maybe in the next 12 odd months, right? Because your debt should be broadly under control by then.
I think Abhyuday just shared with us, by March we will come out clearly with our capex plan, what kind of capex we will be doing.
We're just working on that because like you're saying, we need to also plan it according to the demand and which segments. That is why we are just working on. And by next quarter or by Q4, we can definitely update on that.
Okay, thank you so much and all the best.
Thank you.
Thank you.
Thank you, sir. We have next question from the line of Ashish Kejriwal from DAM Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. So 3 questions. One is, what's your game plan for your overseas operation? We still are seeing that they are loss making, and we tried to do something to make it profitable. So what's the status on that? Secondly, on terms of working capital, especially inventory, because we still are running with high inventory of more than 2 months and 2.5 months. So is there a possibility of when you are reorganizing your supply chain that we can see some kind of reduction in inventory to maybe 1.5 months? And third question is on debt. When we are saying around 3,200 crore debt at the end of second quarter, does this include the moratorium of interest which we have taken into consideration? Thank you.
Okay. Let me answer the last question, and maybe in international operation, I will ask Abhyuday to take a lead, and then I will add later on. That side, 3,200 crore, to answer your question, yes, it includes the moratorium part. So it's the total outstanding at our balance sheet as on date. So it includes interest moratorium, principal moratorium, everything what we have taken. On working capital inventory side, the number-wise, I think directionally, they will brief you that what kind of work we are doing on the operational side. But overall, I know there is an increase in the inventory level at the end of Q1, but now it's coming under control as our sales is increasing, and that was actually unprecedented time because even in the March we stuck up with the very high-end year-end inventory because suddenly lockdown happened and we really could not liquidate. So these 6 months we were really seeing a challenge. But now with things coming back on track, hopefully the inventory level, we are keeping close watch on the inventory level and it should come down.
Yes, so inventory actually I am personally monitoring that, and if you study the company over the last few years, it has really come under control. one thing that we focus on is aged inventory. Because of the cycle that we have and the production process that we have, in the plant WIP, we do need to carry for about 45 to 60 days. But FG is completely controlled and not more than 30 days any FG is increased. Yes, because of Q1, we are carrying something, but I would say next 2 months, even that would be completely zero. And then we're working on just fresh inventory. So there is no actual inventory loss or inventory carrying cost on that. To answer on the overseas companies, Indonesia has seen some recovery now. We are seeing better orders coming in from domestic market and from our export market. Investigation has started because Indonesia was also suffering because of dumping happening from Chinese companies from China into Indonesia. Now the government has also started investigation into dumping of material from China. So that would also help us increase the domestic share, increase our margins domestically. Our service center in Spain is doing very well. I think maybe right now, because if there is another lockdown, that could take an impact. But before that, I think it's doing very well, and we are also looking at maybe adding 1 or 2 more equipment there because demand from Spain and France and Italy is quite strong.
So coming back to our inventory thing, is it possible to reduce it to, let's say, around 1.5 months? Because we are a one-plant company, and someone in a different field, but they are also somewhat converters. They have reduced their inventory significantly. So I was just wondering that when we are reorganizing our supply chain, is it possible ever to reduce it to, let's say, 30-35 days, or you think that 45-50 days max we can do?
See, it will be a gradual process. I would say immediately it may not be possible. The reason will be that because large part of our raw material is imported. And we are, as Abhi mentioned, we are actually working on various things to bring it to domestic, opening the yard next to by the traditional server, but that's a gradual process. So when we have a large part coming as an import, almost 60% raw material is still imported here. And then there is obviously production cycle. So immediately 30-35 days is really not realistic, I would say. I think, yes, in a long run, probably, yes, maybe 1 year down the line, I think certain things will be possible. But yes, we are working really continuous reduction. You said we have really, as Abhi mentioned, we have really seen a good remarkable improvement in our overall cycle. Because we are really closing on the ordering process, just-in-time ordering, getting into the maintaining our the entire material in transit, to the ordering, to the plant level inventory of WIP. But 30-35 days, I think it's too unrealistic at this moment.
Okay. Fair enough, sir, and all the best.
Thank you.
Thank you.
Thank you, sir. We have next question from the line of Nilesh Doshi from JL Capital. Please go ahead.
Hi, Anurag. Thank you for taking my question. The first is on the subsidiary level. I mean, someone did ask, can you give a timeline when you can come at even break-even or EBITDA positive?
So what Abhyuday mentioned, let me just tell you that Spain subsidiary IBER is really now doing well. Barring obviously we cannot commit on what if the second lockdown and how long it's there, but right now it looks good, and I think with this pace, I think Q3 itself we will be having a break even. I don't think IBER will go long because it was generally it maintains on a positive side only because in Q2 and Q1 because of this COVID thing they really maintained some of the negative EBITDA, but otherwise Q3 we are looking on a positive side in IBER. Indonesia, as Abhyuday mentioned, there's certain challenges, but we have really done on our business model, we reworked on business model. With this, we are hopeful in next 1 year. I would not say that next quarter itself will be in positive side, but yes, means it will. You should start seeing some of the positive movements happening. But I think it will be because all these investigations and all these things, correction takes time, as we have seen in India also last time. So maybe around 3 to 4 quarters is still time to get into those type of things. But yes, cash break even, they should come faster.
So can we expect from Q3 onwards a reduction in the PBT because there's a 20 crore loss difference at PBT level? So can we expect the reduction of this 20 crore quarter on quarter?
Q3 will not be realistic for us to commit, frankly. Q3 is because still there are certain challenges and headwinds over there. I think, as I said, ideal thing will be somewhere in Q1 next year, we should start seeing some of the positive movement. I think it's next 2 quarters will be obviously challenging, but you will see the better than what we have been delivering. Obviously, you will start noticing certain improvement, but I would not say it could wipe out the losses.
Second is, Anurag, you have been trying to be very conservative. I mean, if you see your Q2 EBITDA, and if you see the graphite prices are under control, nickel is pretty stable. Although yes, you haven't taken the anti-dumping advantage in the pricing, but the kind of demand what we are seeing from outside, even we have been tracking, I think your Q3 numbers should be much better than your Q2 number on EBITDA side. I mean, on overall yearly basis, you have been guiding, that's fair enough. But and especially when you are running at full capacity, I think you should also get advantage of capacity utilization. So am I correct that yes, you have been conservative, but Q3, Q4 appears to be pretty strong?
No, as you rightly mentioned, because Q3 will surely be better than Q2, because Q2 by September, as Abhyuday mentioned, we reached to a normal level, which is July. So considering that, October, November, December, if we full all 3 months we run at those capacities, yes, you are absolutely right. It should look better than what we have delivered in Q2, no doubt. Q4 also, if the trend continues, yes. But as you know, in terms of our guidance, we always want to make sure that what we give you the guidance, at least we deliver despite whatever challenges come over a year basis.
Right.
So, therefore, we have been saying, because it should not happen that because business could have any kind of challenges at any point of time. So, with this, we are very sure now we have what we guided you for at the beginning of the year for the full financial year, despite the worst quarter was washout. We will be able to deliver. So you should appreciate that at least we were actually taking cushion off from you and cushioning you from all the challenges which we will, and we will make sure that those challenges be overcome as a management team.
The third is what we read and understand is there is a tremendous tight supply in MS scrap globally. Are we facing any challenges in sourcing the scrap, or we have lined up and we are very confident and comfortable that we should be able to manage?
No, we have no raw material side. We have no issues from any of our raw materials currently.
Okay.
So MS scrap also we are well booked and controlled in that.
Mm-hmm. And are you seeing any tightness in the supply side?
No, not as of now. Nothing that my people have got back to me, and there is no intimation of that also.
Right. Yeah. Thank you so much for taking my question, Anurag.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to 2 per participant. We have next question from the line of Nirbhay Mahawar from M Square Capital. Please go ahead.
Just wanted to follow up regarding your CapEx plan. You mentioned that you'll be able to add close to 0.8 million ton of capacity with 1,000 to 1,200 crore total CapEx. Is that correct?
Yes, you are right. So depending on both melting and
melting and rolling together.
Yeah, means our cold roll is right now 0.45, not 0.8. So I'm saying double the capacity. So cold roll will actually then only be 0.45 million when we double it.
Okay. So over what time frame, let's say if you plan if you start from next year, first quarter onwards, what would be the time frame required to complete this CapEx? And
it takes about 18 to 24 months.
18 to 24 months. And if I extrapolate the current revenues and current realization, you will be able to generate close to 10,000 crore plus realization out of this CapEx?
See, if we double, obviously, you can almost match that number, because what we have been running, obviously that same number will.
Yes, you can take that. Yes.
So the incremental capital output ratio is going to be 10 times the capital employed. Is it? Am I reading it right, or there is a catch in this?
Yes, incremental capital employed will be much better, because in any greenfield, because we will be doing at 1/5 of the greenfield cost. This is a brownfield, as Abhinav mentioned, modular way, and the brownfield project. So which is almost 1/4 or 1/5 of the normal capex cost.
Fair enough. And this, the scope of capacity expansion between both the companies, only JSL can expand capacity. Am I correct? JSL Hisar does not have the infra to expand capacity.
So yes, so because of the land bank that we have in Odisha, more of the expansion and growth will come. But Hisar, we are also continuously going to expand there as well. So maybe we can answer a little more in the next investor call.
Special product division.
And yes, we are increasing our FPD there and special steels also. These are two areas. So more value addition is going to happen in Hisar. More high-end equipment we will put there. But for our homogeneous mass production, that expansion is going to happen in Odisha.
Good. Thank you.
So volume versus value. Hisar will focus on value, Odisha will focus on volume.
Yeah, but the operating leverage will happen in JSL.
In Odisha, correct.
Thank you. Thank you.
Thank you.
Thank you. We have next question from the line of Asha Patel from India SME Investments. Please go ahead.
Congratulations on a great set of numbers. My first question is pertaining to the CVD. For what roughly the tenure which we are looking forward, if the CVD gets implemented?
See, as per the government stated times, it comes for 5 years. I mean, as per the process and others, it's generally applicable. Last time when China CVD came, it was applicable for 5 years, and that's the normal process.
Okay, for sure. And last question is, earlier we were also talking about setting up industrial estate in Jajpur for our downstream industries of stainless steel. So what is the current situation?
So that is still on track. We are still working on land acquisition actually with the Odisha government, which we should complete within the next 6 months. And we've already worked on the investment proposal. We're already in talks with getting few people who are going to set up factories there. So the process is on. Maybe, yes, that's a good point you have asked. I will get more details in our next call. Because still land acquisition is where we are still working on. Once that is done, then project detailing, mapping of the whole land and how we're going to create the infrastructure, all that is done. We from our side are completely ready. It is just when land acquisition, when land is with us, then we can start the work.
So the way in which we would be benefited is that our secondary industries would be just by our side, so logistics cost would be reducing.
So basically, we will be creating the market. Now, just to give you the example, what we're trying to do, from our Hisar factory, 80% of the sales happens within the North Indian region. So even though raw material we need to bring it, there's a huge logistic cost, but the market is right there. So same thing we want to do in Odisha. Raw material is also there in Odisha, and if we can create a strong downstream industry there, then I would say not all of it, but at least 40 to 50% of our output from there can go into these industries.
So logistics cost can be saved basically, huge synergies can be generated there.
Yes, tremendously will come down because we are in the raw material belt and the market is there. Right now, the East market is growing actually at 15 to 18%, but the volume is still from North and West India and South. But once we create the East market, once that grows, then we control practically all four regions, I would say.
So currently in volume terms, how much are we selling? How much are we able to sell in the East market, in and around Odisha?
It will be about 10 to 12,000 tons only.
Okay. And so what would be capital outlay from our end? So when you are selling, when we say that we are setting up an industrial park, So do we bear all the cost pertaining to the land acquisition?
Yes.
Okay. And roughly how much do we plan to spend on that?
The infrastructure and the land we have to set up, then we will monetize it by bringing in our customers.
So it will not be strain on our balance sheet because yes, means we will facilitate everything and eventually it will be monetized because we by transferring to the smaller, because they cannot individually do those kind of acquisitions and facilitation with the government. So those they will do, but it's not that we will be taking it on largely on our balance sheet.
Got it. So more fixed assets won't be blocked basically.
No. This will not block our asset side.
Sure. That's all from my side. Congratulations. All the best.
Thank you.
Thank you very much, sir. Ladies and gentlemen, due to time constraint, that was the last question. I'd now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you, everyone. I would like to thank everyone for attending this call and for showing interest in Jindal Stainless Limited. JSL remains positive that its strong positioning in the stainless steel industry, improving macros would help it deliver steady and consistent growth going forward. I hope we have been able to answer all your questions. Should you need any further clarification or would like to know more about the company, please feel free to contact our investor relations team. Thank you once again and wishing you all and your loved ones a very happy and prosperous year. Happy Diwali and a prosperous year ahead. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Jindal Stainless Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your